Most people think they're diversified. They've got some stocks, maybe some bonds, maybe a REIT or two. But here's the truth. The way most investors are allocating capital today is fundamentally broken. The old playbook is 60% stocks, 40% bonds. It just simply doesn't work anymore. It leaves you overexposed, under-diversified, and with returns that don't reflect where the real economy is actually happening. In this video, I'm going to break down why that is, how the investing world has shifted under your feet, and what a smarter strategy looks like for building long-term wealth. Let's start with the public markets. On paper, they look great. The S&P 500 has had strong returns, bond yields are decent again, and ETFs make it simple to own everything. But look under the hood. 25 years ago, there were about 8,000 publicly traded companies in the US. Today, closer to 4,000. Half the opportunity set is gone. Not only that, but 10 mega cap stocks now make up about 40% of the S&P 500. That means when you buy the market, you're really just making one concentrated bet on a handful of tech giants. So you think you're diversified, but you're not. You're overexposed to fewer names, fewer industries, and higher valuations. And that creates fragility. If one of those tech giants stumbles, your whole diversified portfolio wobbles right along with it. Now here's the part most investors miss. Public markets aren't the economy. In fact, 80% of GDP, 80% of job creation happens outside the public markets, in private companies, private credit, real estate, infrastructure. The bulk of wealth creation isn't happening in the shrinking pool of listed companies. It's happening in private markets. Yet most investors don't touch it. Why? Because we've been conditioned to believe that public equals safe and private equals risky. That's outdated thinking. The real difference isn't risk. The real difference is liquidity. Public markets are liquid. You can sell tomorrow. Private markets are less liquid. But in exchange, you're often getting paid a higher return for the same level of risk. Let's talk performance. Over the last 2 decades, private markets have consistently outperformed public markets on a net basis, even after higher fees. Private credit has generated stable yields above what you'd find in bonds. Private equity has delivered higher returns than public equities in 21 of the last 22 years. Real estate and infrastructure have offered cash flow plus appreciation. So the question is, if private markets are where most of the economy lives and they've delivered stronger results for decades, why are most investors still allocating like it's 1985? The answer is access. Institutional investors, endowments, pensions, family offices have been living in this world for years, but individuals are only now starting to get access. Think about the pyramid of investors. At the top are the big family offices. Many now allocate more than half of their portfolios to private markets. Below them are high net worth individuals who, thanks to new structures, are increasingly able to invest in institutional quality private funds. And now retail investors are beginning to get access too, through 401ks, ETFs that blend public and private exposures, and new platforms lowering the minimum check size. This isn't a niche anymore. This is a structural shift. The best capital allocators in the world have already moved here. Everyone else is just catching up. Whenever private markets come up, the same objections get raised. They're illiquid. They're not transparent. The fees are high. Returns are going to come down. Let's take them one by one. Illiquidity. It's true. You can't sell tomorrow, but that's the trade-off. You get higher returns because your capital is patient. And now we're seeing more flexible structures. Private credit funds with 30-day redemption with windows, for example. So the liquidity problem is being solved bit by bit. Transparency. Private markets used to be opaque, not anymore. With daily net asset value reporting and improved regulation, they're becoming just as transparent as many public vehicles. Fees. Yes, they're higher, but creating investments is fundamentally more expensive than just buying what's already public. You're paying for origination, structuring, management, and the net returns still justify it. As for returns compressing, people have been saying that for 20 years. Yet private equity, private credit, and private real estate continue to outperform. Here's where things are heading. The dividing line between public and private markets is going to blur. We'll see hybrid products, maybe 70% public, 30% private, wrapped in a single ETF. We'll see 401ks that give you exposure to private credit alongside equities and bonds. The question won't be, should I be in public or private? The question will be, how much liquidity do I need? That's the future. Liquidity management, not public versus private, will become the main axis of portfolio construction. This is huge for anyone serious about wealth building. Imagine your retirement account isn't just stocks and bonds, but also owns private real estate, infrastructure, and private credit. Assets that throw off steady income, compound at higher rates, and uncorrelated with the public market. Roller coaster. Other countries are already there. Australia, Israel, Chile, they've integrated private markets into their retirement systems. Their citizens retire wealthier because of it. The US is moving in that direction too, slowly but surely. And along with that, I think we're going to see the return of lifetime income products, modern versions of pensions, guarantees that ensure no matter how long you live, you don't outlast your money. That's where this is all headed. So let's bring it home. The old 60-40 playbook is broken, it's not diversified, it doesn't reflect the real economy, and it leaves you at the mercy of a handful of public companies. The smarter play is to broaden your lens, incorporate private markets, focus less on whether something is public or private, and more on the actual risk, return, and liquidity profile. Because in the next decade, the investors who thrive won't be the ones clinging to the old model. They'll be the ones who adapt, who build portfolios that reflect where value is actually created in the economy. If you want my help building your private markets investing playbook, click the link in the description and book a call with me. The world has moved on. The only question is, will your strategy move with it?